Julian Callow joins us now. Julian, thank you so much for joining us today. Now, in terms of what we heard, there seems to be a little bit of an optimism boost in a lot of the markets because they're hoping for QE3. We were speaking to Edmund Phelps, and he says he was for QE2, but QE3 just doesn't make sense because there's, no chance of stagflation or deflation. Do you think we'll hear from Ben Bernanke that QE3 is on the cards?
Our view is that it's not going to be said to be on the cards by the Fed chairman. At the same time, I must say that having watched Bernanke over the years, I think he's quite good really at communicating in a way that brings a good understanding to markets of what could happen and also what might happen if things don't go according to plan. In other words, he's, I think, likely to carry some hints that the Fed can do more, in particular that although interest rates are very close to the zero bound, there is still more that the Fed can do. One interesting idea, for example, that our US economists have been exploring is the idea of a so-called Operation Twist, which is where the Fed would actually lengthen the duration of its portfolio of Treasury holdings, and that could also have an impact in terms of tying down not just short-term interest rates but long-term rates. So you've got to remember that there's really a big palette of options still out there that the Fed can use. The question is whether really the Fed does need to deploy them, and actually this is also very important.
That's the million-dollar question. Does it need to deploy these extra measures?
And our view would be probably not. In fact, of course, it's all going to hinge crucially on the economic data. It depends whether you view the current weakening in global business confidence as a typical mid-cycle fluctuation, and we do have them in all business cycles, or whether you regard it as something much more serious and the start of a double dip. Now, our view is much more inclined to the former. We would argue, in particular, that commodity prices have been exerting a very large degree of drag on household spending power. In fact, probably about 1.5 percentage points of negative impact on annual growth rates this year.
And Julian, I also want to get, of course, your view on Europe, because we're seeing more and more either investors or also Nobel laureates saying that whatever happens, one or even two countries will have to leave the Eurozone in the next year or so. Is this really feasible? Do you think that someone has to leave the Eurozone, and does it mean that the Euro can survive if we start, chucking out members?
It's all going to be decided on a cost-benefit basis. Ultimately, countries always act in their own national interest. If a country leaves, then for sure it gets some short-term benefit from currency depreciation. But there's enormous costs involved. It would really, I think, be outlawed by the rest of Europe for daring to leave the euro area. Huge costs to its own financial sector, to the financial sector. More generally, to pension funds, etc. So I really don't think that's going to happen. I think still that European governments will find a way. It may take extreme measures. The European Central Bank may have to step in and buy very large quantities of government debt to hold this thing together. We have to think the unthinkable here. But still, I think ultimately people will not want any country to leave. It's just completely against the EU treaty. It's meant to be irrevocable fixing. That is what the Maastricht Treaty said.
Yeah. Julian, thank you so much. Julian Callow there from Barclays Capital.